Alright everyone, time for the next episode. Okay, episode 7. So last time we spoke about liquidity. Now, before liquidity happens, sometimes we meet up with volatility. And what is volatility? Volatility is when there's a great bias towards a certain price. Here is an example. Yeah, so it's when a candlestick basically goes all the way up or all the way down with no interruption. That means that there was a great bias, a great demand or a great supply. Without any interruptions, everyone wanted for the price to go there until liquidity arrived. And once liquidity arrived, people started changing their bias because most traders decided to stop their bias. They decided to end their bias and exited the market. And with people exiting the market and no longer entering, or maybe entering later, there is liquidity. But yeah, we're talking about volatility right now. Volatility. Why is this important? You may ask. The reason why volatility is important, because through volatility we know that great biases and great movement has been present, has happened. There was a really big desire for price to go to a certain range. Now with this volatility, it might either be an end of a trend or a beginning of a new trend. By knowing how to analyze the volatility, you can further know where price might go. Because volatility will tell you a lot of information. When there's volatility, usually because it was a great bias. That means it was basically a stable price. It was where a lot of people passed by a certain price range that they all liked. So with volatility, you can always assume that price might go back to volatility, because volatility is where price was the most stable. There was no exit or entry there. It was just one bias. It was just one great demand or supply. That's why great bias is great movement, which will be of help to you, because by seeing a volatility or volatility candlesticks, you can know a trend. That's one. You can know if there will be a change of trend. You can know if that is the end of a trend. You can know if price will be going within the volatility, within that price range. So you can expect price to go up a bit higher. You can expect price to swing around that area, and you can expect that price won't easily go down again or go up again, depending on what the volatility is. Because let's say, for example, the volatility is an uptrend, an up candle, a green candle, then you can be sure that price will not easily go to the bottom again, to where the volatility started. Price will keep going up, will remain in that area, or will float somewhere high and low around that area, but it won't go extremely low unless there is a great desire to go low, unless there's great liquidity to go low. that is usually not happening unless something big happened in the economical state of this world. But you won't see that happening easily unless it's a lower time frame or a really high time frame. Because lower time frame, the market is basically unstable on lower time frame because yeah, it's a short time. A lot of things is happening within a short time. There will be packed information within a short time. And on bigger, very high time frames, it's basically a long time and yeah, too little details for a long time. So you'll just see price going all the way down or price going all the way up. I'll show you an example of that. But yeah, that is basically what volatility is for. It is to know where price might be headed. It's a safety break, a safety, it's a safe area basically. It's where you can know how to continue further with your trade if you're gonna trade further for continuing price, continuing uptrend or downtrend. It's where you can assume to take profit because it might stabilize around that area, it might go on a reversal. Yeah, that's it pretty much for volatility. Alright, well, let's continue because passing on my wisdom to you is important. Yeah, but yeah, peace out for now. I'll I'll be back with the next episode soon.